Well, welcome to Under the Radar Report. It's great to be here with Matthew Kidman from Centennial Asset Management. Welcome Under the Radar, Matthew.
Thank you, Richard.
Well, I mean, I've known Matthew for a long time, and I guess what's interesting to people at the start is hearing about the fund's philosophy, like what, because you do some interesting things here at Centennial, which is why we're talking.
Yeah, the interesting thing about our fund is it's the Level 18 fund. That's the fund's name, managed by Centennial Asset Management, which is
right.
Myself and Gary Joffe. Gary worked at Elliston, I worked at Wilson Asset Management.
Yep.
And we decided, well, let's go and manage our own money.
Yep.
And we did that for a while, and then we thought, let's have a small fund.
Yep.
that concentrates on small cap companies.
Yep.
But it has a lot of flexibility. And the reason that was because we put all our money into the fund.
Yep.
And we managed it as if it was our own money. So what does that mean? It's not mandated to really do anything. So you'll get a lot of your funds that say we're 95% invested,
yeah.
We're long only, this is what we can do. And it's very rigid.
Yeah.
And that works over the course because we know markets go up 7 out of 10 years.
Yeah.
What we did, though, we liked the idea of maximum flexibility. Sure, we're long most of the time. We have 40 stocks.
40 stocks, right.
Around 40 stocks,
Yep.
give or take. There's always some going in and out in the small cap world, so sometimes a bit longer than that, sometimes a bit less, depending on how you feel and where you're up to in your execution. But what it gave us was flexibility. So, for example, when COVID hit, we had that horrible 5 weeks going back 3 years ago now, feels like a lifetime, is when the world was shutting down, we managed to go to 90% cash.
Right.
Take a deep breath and try and work out what the hell was going on.
Yeah.
We reinvested over the April, May. It took a little bit of convincing, but we got there.
Yep.
And we're able to then, over the next 18 months, do quite well because we're on the long side. Now, we will lose some money, but it's trying to mitigate that loss and then capture the upside.
So you're taking market risk, or you're trying to look at market risk from a top-down perspective.
Yep.
And that's managing the cash that you have in the fund.
We'll have that kind of overarching philosophy, but we'll also do it in the stock. So we'll never be overly concentrated. We'll never gear.
Yeah.
What we do, you just summed it up, we manage risk.
Yeah.
And our risk environment is the equity market and mainly small caps. We can do large caps. Yeah. That's a risky area. Yeah. Nothing is too big to fail.
Yeah.
So things can just disappear overnight.
That's true. In terms of the types of companies that you're looking to buy, what would you say? What would you put on your wish list there?
Yeah. So that lends you to what do you look for in companies? Well, one, we don't over concentrate. Yep. Two, we've got an eye to liquidity.
Yep.
And then we start to look at the companies. So manage the risk and then look at the companies.
Yep.
So obviously valuation matters. Valuation will vary from the type of industry it's in, the growth rates they're achieving. So you've got to be flexible about what you do with valuation. If you've got a high growth, high returning business, say going back 15 years and you found realestate.com as it was then, REA.
Yeah, right.
And as it went past that break-even point, you realise the numbers it could produce and how much money it could produce and the returns, you're going to give it a bigger multiple.
Yeah.
That's obvious compared to maybe a cyclical company like maybe media company of the old world that will trade on a very low multiple because we know outside the cycles, up cycle in an economy, down cycle with higher interest rates, it's going to kind of earn in a range. What we look for are companies that can grow. Yep. Otherwise, if you've got no growth, why don't you hang out in the top 20?
Yep.
They've got much more liquidity, much more robust business models and franchises and attract a lot more investor interest. So we hang out down here. So they've got to be able to fund themselves as best as possible. That doesn't mean that if they're doing a good acquisition, we won't give them money to do it.
Yep.
But they've got to have a business that funds that growth.
Yep.
Hard mix, because most businesses, when they're young or small, can't fund the growth that they can see in front of them. They need a lot more money. Yeah. So we try and look for that. How do you find that? Well, normally, the biggest risk in any business is the balance sheet risk and the cash flow. So a lot of people, especially as bull markets get into their immature stage, just forget to look at those type of things. And
so solvency is a big deal in terms of the first box you want to tick when you're
solvency, definitely.
Solvency and growth.
And growth. Otherwise, you'd be somewhere else. I like a small business with no debt, with cash on the balance sheet.
Exactly.
And hasn't raised money. Why? because that is the story of its life.
Yep.
It's been able to deliver cash on its balance sheet.
That's right.
And if it's still growing, you go, wow, that's not a bad outcome.
That's right.
So there's that element, and then there's the cash flow.
It's the blood that flows through a company.
Correct.
To keeping it alive.
That's right. So sure, you can grow sales, grow profits, but if it's not a great cash earner, and we've seen a lot of them in recent times, for example, the online retailers, that Kogan, Temple and Webster, they had this great growth profile, top level, but they kept churning money marketing the product.
Yeah.
Never really made money.
Yeah.
But for some reason, people thought it was worth a lot more at one stage, and so on. That doesn't suit us. So solvency plus, maybe that's the way I like net cash, or close to it.
Yep.
Good cash flows after you take into account CapEx, working capital, how fast it's growing, and so on. And then, obviously, the P&L, which everyone looks at, is important, but it's got to come off the back of those.
Yeah.
That's what we look at.
Well, I'm just getting technical for 1 second, because it's really interesting what you're saying about, the dynamics between profit, the P&L, and the cash flow statement. What would you look at in terms of return on equity or return on invested cash?
Yeah, well, it's got to get its cost of capital, otherwise you're going backwards. We know that. And that's a good starting point. Depends on what industry and valuation. If you go back to the REA example, the ROIs are probably, I'm guessing now, but they're high single digits, while down
double
here,
digit.
Double digits. Sorry, while the some of the industrial companies and whatnot are high single digits.
And does this philosophy sort of allow for the REAs who have been disruptive forces in the past, and in your fund you have many disruptive type companies, like REA was? Now it's a mainstream.
Yeah, that's right. That's a terrific question, because you don't always see it.
No, you don't.
And when you're going through, you go, well, you don't kind of believe it. It's one-off, it's whatnot. Someone will disrupt them once they get going. Exactly. So they're hard to see, and they tend to get on valuations that start to take it out of your realm.
Yeah.
So valuations overlay everything we've said. So you're 100% right. Sometimes you pick it, but you mightn't stay for the whole ride because you don't think it's sustainable.
And does this philosophy conducive to mining? I know you own some mining services.
Yeah, so mining of the commodities themselves directly, the miners, can have some years where those returns and those profitability and cash flows are stunning. But the problem we have is they've got that extra layer. They've got no control over the commodity price. You kind of got to pick the cycle and just see what's available at the time. And down at the small end, the explorers, all they're doing is raising money in the hope that they can get there. Well, sometimes it's better than hope, but a lot of time it's hope. So we don't do a lot of mining. There are exceptions, and you pick it up in the cycle, but it's never a big part of our portfolio. The mining services companies tend to be a step up from that, because they'll tend to be, if they're good mining services companies, they'll sign contracts 1, 2, 3 years on a project, and they'll be into those bigger miners as well. So they're a little bit better, but you would never ever pay too much for a mining services company, because they've got big customers and it's cyclical.
Yeah. And so with that in mind, what have you been buying recently?
Yeah, that's interesting, because I've just gone on and on about small caps. But the bear market that we've been in, one of the things we can do is we can go to the big end of the market.
Yep.
And so we've done a fair bit of that in the last year or so, especially when things were depressed in June and then again in October with those big caps. And it does allow you to invest in things like REA.
Sort of a flight to quality.
Flight to quality. We can do that. It's not our natural habitat.
No.
We won't stay there too long.
Well, I haven't seen you at any Telstra investment briefings. But...
No, but we do. We have owned Telstra.
I know.
We've owned Telstra. That's
so you're still buying? Are you still? Do you still own it?
Yeah, we still do.
Okay.
And so the other thing that we didn't get to, when you go to push the button on buying or stock or selling, we look at all those things we talked about. Then we look for a catalyst. We think, what's the right price? What's the catalyst to change that price? We're small enough to do that. Some of the bigger funds have got to buy it anyway. Hope the catalyst comes, or the change, the re-rate comes later on. We look for a catalyst. So with Telstra, if you go back, I know it's not a small cap, but it had a couple of those features I talked about. Never really got a good return. It had a lot of competition that came in. Then it got the NBN problem. And so it had very messy around that. There was discounting in its main market, which is the mobile market.
Yep.
A couple of those markets have turned around. As we know, mobiles, we've just seen price rises this week.
Yep.
But they've been behaving better over time. And of course, some of their competitors have had some issues, like Optus and Vodafone over the years. Telstra, for all its complaining from its customer base, is kind of the go-to in that market. Now they're getting price increases, so stabilisation and margin return in the mobile market. And of course, with NBN, they eventually worked that out and how they would operate.
Yeah.
Sitting in there is potentially an infrastructure asset as well.
Yeah.
So there's some latent value. Not a bad balance sheet. Big company, you can carry a bit of debt, unlike the smalls. And we thought that there were a number of catalysts, and it's been very good for us over the last 12 months when things have been tough. It's kind of gradually re-rated, not like a small cap would, but it's been a nice earner for us. What's it worth? We think 450, 460. We're not far away.
And what sort of other stocks have you been gravitating to, of the 40 stocks that you're sort of in your fund?
Yep. So you're always looking for areas that are doing quite well, and you've hit upon a point. But you've got to try and find the industries that might be going okay, or individual situations. Yeah. So, for example, mining services haven't been too bad.
No, they've been. We've found that too. Yeah.
Yeah. So that's been really good, because even though commodity prices probably peaked in general last year, there's a lot of activity going on, and that's the key for mining services. Now, commodity prices can't collapse because eventually that hits everything. But if they gradually come down, there's a lot of demand for different metals and different commodities around the world. And the mining services companies, after an initial coming out of COVID where they were short on labour, that's kind of correcting now. So I think I mentioned to you in the round table back going into Christmas, SRG was one of them. Now, SRG does more than just mining services. They're infrastructure as well, but they played in that area, and they're based in Perth. And so they're competing for that labour in a lot of places. That's done well for us and continues to upgrade its earnings, got good cash flow, made an acquisition too that was very selective. We don't mind that as long as they don't get too carried away with it.
Yeah.
So that's been good. Another one which is capital light. So you also don't want a mining services company where, and I'll give you an example in a minute where it can happen, where they've got to fund a lot of the projects for the big guys because they haven't got the whip hand. The big guys say, well, you're going to do that. One of those is an engineering company called Lycopodium.
Oh, okay.
The code's LYL, been very good for us, one of our bigger holdings. Not that liquid, but engineering does most of the studies and plans for building various mines. Happy to go anywhere in the world. They do gold, they do lithium, they do virtually anything, copper, nickel. And so if you go back, I was saying there's a lot of activity. Their book's really full at the moment. They're quite cheap. Balance sheet, 90 million of cash. Market cap, less than 400 million. Now they'll tell you, some of that is for bonding.
Bonding.
We need it, and they've never used it, as far as I can work out. Very good at managing their contracts, because that's the risk. You get into a contract, and the contract doesn't work out. But luckily, they don't have to buy materials, goods. It's just charging for their services, and that's a hot spot at the moment. They're doing quite well. They've got a big pipeline, so that's worked for us. Another little one we came across. We're in Perth last week. Is a little thing called XRF Scientific.
Oh, they do assay test or assay.
It's like a chemistry set for all those scientists out there. They go and they mix up this powder, which is called flux, and that gets put in with the assay samples or the samples out of the mine, and they mix it up, and it gets rid of all the impurities, and then you can see what's actually in that sample of dirt. And so they're doing that. That's going quite well at the moment. So there's another little mining services company that does quite well.
A good niche too that they're in.
There's competitors, but they probably don't do the full range. And it's a global business. There's mining all around the world, and of course the other thing you want is competitive advantages. Breville is a great brand.
Yeah, I was going to say.
If anyone saw been in an American kitchen, their appliances are from 1950. We're way ahead. The Europeans are at the top end, but Australians do quite well in the middle. So there's little niches like that you pick up on. So that's all fine. Then we're trying to be very selective in the small end and try and find companies that something's going right with them at the moment. Something that's re-rated, but let's talk about it, which is in a tough industry, is Lindsay Brothers.
Oh, God. I mean, that's what, was just stuck at 40 cents and now it's over $1 or something.
It's taken off,
It's taken off because of...
Yeah, well, it's gone from 40 cents to $1.35, $40. So that's, what is that, 200 and whatever. And we still think it's got some upside. But a couple of things happened there that are catalysts that we talked about. So you go through the whole thing. That kind of business never pay a big multiple. But then a couple of things happened that made that business slightly different. So COVID happened, and they cart, cold storage is a lot of food, obviously.
Yep.
And so people staying at home, the big Woolworths, Coles, Metcash all did very well. Then coming out of COVID, there was price inflation. And guess what? They were beneficiaries of that. An inflationary environment's not bad for everyone because everyone puts up their prices.
Yep.
And sometimes you can tweak a bit more margin when prices are going up, gives you a chance. That happened. Same time they were introducing not only trucks, but they were transferring a lot of their stuff onto rail. Yep. And rail's a lot more effective because it's cheaper, and the bigger wagons and whatnot, you can deliver cheaper, better returns. So they've been doing that gradually, and now that's been accelerated. And then you said the biggest catalyst of all was their main competitor, Scott's, bought by PE, overgeared, bad contracts, went broke. These guys have come in and mopped up certain parts of their businesses and renegotiated contracts. The next year's going to be good for them.
Like you've had a long career, as we sort of said at the outset. Not that long though. We're still pretty young. Well, we like to think of ourselves as young, but what would be like one or two big learnings that you've got from managing money for so long?
All the things we talked about. On top of that, a couple of things that I've learned are probably not even so much to do with individual stocks and how to invest. Just about anyone can invest.
Yep.
At an individual stock level.
Yep.
If you take the time, you'll find some stocks and you go, I did well in this. And you'll always hear people around that, I'll meet them on a Saturday night and they say, I've been in this stock and it went from here to here. And you go, that's right. Well, I've got to find 40 of them the whole time.
Yeah.
So you've got to know how to manage a portfolio. And that's a different game altogether. What weightings to get, keep finding stocks and putting in. So one lesson I've learned is everyone you ever meet knows something about something.
Yeah.
Always ask, what do they do? And what industry they're in. Now, sometimes it'll come up a donut, but more often than not, you'll find people that are doing something. You go, oh, that's interesting. I was talking to someone just yesterday, and I said, what do you do? Never met the person. He goes, I've got two businesses. I said, tell me about the first one. And he's got a residential servicing business, so he does lawns and windows.
Yeah.
And I said, okay, so how's that going? He goes, it was booming until about a month ago, and it's dropped 50%. And you kind of think, that's interesting information. Now, that's a small unlisted business, but you kind of think, okay, so maybe the slowdown is starting to take traction, at least in Sydney. So that's what you learn. Always ask people what they do and try and work it back. Not in a disingenuous way. You've got to be curious and take it on board, but you can always use it for work. The other thing is always try and stay positive, because the thing that the share market does, it punches you in the head quite regularly.
Yeah.
So you'll have a bad investment. The first thing and then something good will be staring you in the face, and you say, I haven't got risk tolerance at the moment. I've just lost, $200,000 on that.
Yeah.
That's hard to take. I feel a bit sick in the stomach.
Yeah.
There's been a downgrade or I missed some element to it. And then you've got to turn around and say something here. And you've got to have the confidence to say, righto, my process works. It's done before. Let's go again.
Yeah.
So try and stay as confident without being arrogant as you can, and understand you will make some mistakes. Now, I said the share market will punch you in the face, but it's a great leveler. Also, it always gives you another opportunity.
Yep.
Most businesses, you make a mistake, you're gone. It's like batting in cricket.
Yep.
Oh, straight through, gone.
Yep.
Share market lets you bat and bat and bat and bat and bat again.
Yep.
Or, as my old colleague Jeff Wilson used to say, I can back every horse in the race and get some kind of return.
Well,
I don't have to back one.
Portfolios you think he is, but
so they'd be the lessons. People just stay confident, back your process, and get you don't have to do my process because you're a different person to me, and you can't copy someone. You've got to just bring yourself to the market, but just stick to some fundamentals and be confident.
Well, thank you, Matthew. Thank you for joining us under the radar.
And by the way, I'm quite bullish.
Right. By the way, Matthew, the author of Bulls and Bears is a bull today.
Yeah, I think the worst is behind us.
Well,
the economy will be soft this year, but I think the market's seen the worst of it, we're heading higher.
The darkest hour.
The darkest hour is past.
I think we're going to see some light ahead. Thank you, Matthew, for being under the radar. I've really enjoyed it, and we'll speak again soon.
Thank you.